Let's now discuss the purpose, accounting, and financial reporting for investment trust funds and also private purpose trust funds. As I've already highlighted, these two phrases have the word trust in them. And we are learning about fiduciary funds. So fiduciary trust funds are used when the assets being held are administered through a trust. So there's a trust agreement. The government, who is basically got the oversight or of administration of this trust, is not a beneficiary of them, and the assets are even legally protected from the government's creditors getting at them. The assets are intended to benefit very specific recipients in accordance with some type of terms that were set up by the original party who established the trust. Let's talk first about external investment pools. External investment pools are when external parties get together and pool their investments. They're going to be managed as a large group. They hope that they will have lots of earnings off of this investment pool. For example, gains on sales of items held within it, interest and dividends, etc. These external investment pools require the use of an investment trust fund when a trust agreement is in place. The investment trust fund accounts for the external party's share of the investment pool only. So I need for you to make sure you totally get this. When we are looking at the fiduciary fund financial statements, we are looking at the assets, liabilities, revenues, expenses, etc., as they relate to parties outside of the government that we are dealing with. These are the external participants, equitable amounts held within the investment pool. If the government happens to have investments in this same pool, their amounts are going to be reported at the fund level for the funds who have contributed and at the government-wide level as well. So again, fiduciary fund financial statements do not include anything for the actual government that we are dealing with, only the external parties for which they have a fiduciary responsibility. With investment trust funds, we are going to use economic resources focus and accrual-based accounting. In regards to investment trust funds versus custodial funds that we just discussed in the segment before this one, recall that we had discussed administrative involvement and direct financial involvement. And we said that if the government monitors subrecipients for compliance, determines how expenditures of the subrecipient have met eligibility, or has any discretion over the allocation of how the items are used, then they've got administrative involvement. And we call those pass-through custodial funds that we were talking about. So if any of those are not met, the government has no involvement, can't say how it's to be allocated, etc., then we have to use a custodial fund because it's only custodial. We also said direct financial involvement. So in other words, if the government happens to have to match the funds of the activity, then it does not have to be kept in a custodial fund because it's not custody only if they've got to match the grant funds. So in regards to this investment trust fund question, if we have items, assets held and they are not held in a trust, but they meet the criteria for a custodial, as we've discussed earlier, they don't this, they don't that, etc., then it would have to be kept in a custodial fund. Otherwise, we're going to hold these in an investment trust fund. Now, regarding this reporting and recording that we've got to take a look at for investment trust funds, typically, the administrating government is a participant in the investment pool. So like I said, what we're going to do is make sure that when we do our recording and our reporting, that what we're going to be doing is separating out what is the government's equity in the pool, the government's funds that happen to have contributed something into it. We're going to keep up with it at the fund level and at the government-wide level. All right, so we're going to show the government's items in the governmental activities column and the business type activities columns if it happens to be proprietary funds that pitched in. And then for the external parties, their amounts are going to be shown on the fiduciary fund reports. No government-wide level whatsoever. No fund level whatsoever, because they're not our funds. These are external parties. Now, the external parties are going to have to keep up with it on their books, but we're concerned only with our government at this time. When we account for it within the investment trust fund, when we have other funds of our government, we're going to use due to Fund X, due to Fund Y. These are their amounts, and of course they're going to show it at the fund level as, let's see, hang on, missed my note. Equity in pooled cash and investments. All right, so inside the investment trust fund, we're going to use due to account for what we owe to our government's other fund areas. And then they, at the fund level, are going to show that they have equity or asset in pooled cash and investments, and they're going to track their own numbers within their fund level. Again, participants can be from any of the governmental fund types that we've talked about, or even proprietary fund types. Another term that we are going to be using would be additions for changes in fund fair value of investments, or deductions for changes in fair value of investments. Because think about it, just like a business entity, when we are at period end and we're needing to show the fair value, we may have unrealized gains or losses. So hopefully you guys recall and remember how that works. Unrealized versus realized. Realized have actually come to fruition. Unrealized are if we were to sell them at that particular date, this is what would have happened. We would have realized the loss or realized the gain, but we didn't, so that's why we call it unrealized. So we've got earnings that we're going to have on these investments, and then we've got changes in fair value. And this brings about an issue, because if you think about what I said, we're talking about an investment pool, and that means that different groups are going to be throwing in money to the pool. Funds from our own government, and then external parties of some sort. And this is going to be multiple. So what we have to do is keep up with the proportion of each investor group, each fund, each party, based upon what they have contributed and also what their earnings are. So you can imagine how complicated this can get. But basically, what happens is we have to revalue the fund assets when a new contribution has been made by someone. We also have to revalue our assets when somebody makes a withdrawal, whether they withdraw only part of their holdings or they take out all of their holdings. Because think about it, the relative percentage is going to change with those kinds of activities. So we basically use a weighting mechanism and consider their amounts since the last time we did this revaluing. And we would do journal entries, and what we would do is recognize their new amount of equity, and then we would take out their old amount that was calculated the last time, and the difference between the two is either going to be credited to revenues it's revenues change in fair value of investments, or it would be debited to revenues change in fair value of investments if it happened to go down in value. Which brings me to undistributed earnings on pooled investments and undistributed change in fair value of pooled investments. These are some accounts that are utilized in order to track a lot of the activity within the investment trust fund. If we look at the undistributed earnings on pooled investments first, think of it like a liability. We would credit it when we've got earnings that have been received by the investment trust fund that need to be distributed at some point. And then when we finally apportion the pro rata share amounts to the particular investors in the pool, then we would debit it and close that down. In regards to the undistributed change in fair value of pooled investments, again, it's like a liability account. Draw a T account and think through what I'm saying here. When would we credit undistributed change in fair value of pooled investments? That's like saying we owe somebody for the change. So if we want to increase what we need to distribute, we would credit it. Gains realized at sale would credit it, and at fair value. And then when would we decrease it? Losses realized at sale, or losses recognized at period end when we've got to do that fair value assessment. Now, using that, we're able to net the gains, both realized and unrealized, against the losses, both unrealized and realized. So we would initially have either a net credit, and it would be undistributed, or we would have a net debit, and it would be undistributed. Hopefully, you're typically going to have a net credit, gains, realized or unrealized. And what we would do is close that out and apportion it to the participants. All right, so we need to get it where when we put the financial statements together at period end, we would need to show what our external participants' values are. And then our internal participants are going to show at their fund level and at the government-wide level as necessary what their shares are. So we're going to close out at the end of the period. And one thing that you're going to see when you look at examples in the text regarding how these statements look for the fiduciary funds, we are going to show additions to and deductions from. So you can go and check out some of the examples that are held within the chapter. Let's now talk for another few minutes about the private purpose trust funds. Again, please notice that I've highlighted for you the word private purpose trust funds, the phrase there, because I'm wanting you to focus on the fact that, again, we've got to make sure that we understand that the words mean something. Private purpose trust funds are different than public purpose trust funds. We discussed public purpose trust funds way earlier, and those are when the government benefits from the trust, or the public at large, the citizens of the government, benefit from the trust. So public purpose. If the government's benefiting from it, the people are benefiting from it, and the people are the public. All right, so we had said when we've got those kinds that we either account for them as a permanent fund or as a special revenue fund. And we had discussed that when we talked about the governmental fund types. So permanent funds are used when we've got public trust funds and the principal is non-expendable. And then for public trust funds where the principal and the interest are both expendable, we said we would use special revenue funds for those. But here we are in a later section, and now we're focusing on the word private purpose trust funds. Private purpose trust funds are when a trust agreement is established by an individual or an organization, and the assets are to be managed and are for the benefit, now or later, for a specific purpose, a private purpose, and for the benefit of an individual, an organization, or another government. For example, given in the text, they mentioned the state-sponsored 529 college savings plans. That's basically where parents throw money in or contribute into this plan, and the state manages the plan, the investments of the 529 plan, and then later it's withdrawn to pay for college tuition. All right, so it's got a private purpose. The students are going to use the money, and the government does not benefit in any way from the trust fund. And it's not really the general public either. It's not a whole bunch of people. It's specific people that are going to pull out the money from this private purpose trust fund. All right, so how do we go about accounting for these? It's fairly easy because we've seen examples already of how to do it. We're just going to be following suit in things that we've already seen. So, if we have a private purpose trust fund and the principal is non-expendable, in other words, it's functioning like an endowment, then we're to follow the permanent fund type of examples that we saw in an earlier section. The only exception to that is that, again, these are fiduciary funds. Therefore, we're going to kind of follow the same principles and journal entries, but there is nothing reported for these at the government-wide level. It's only covered in the fiduciary fund reports. And then for the private purpose expendable, we're going to follow the investment trust fund approach that we've seen or can see in the examples in the text, because we're trying to keep up with the investments, the principal portion and the interest portions, because both of them can be spent, And we've got to track all of that and make sure it gets to the right parties based on how it's supposed to be used. We'll talk later a little bit more about the fund financial statement.